What is microprudential regulation? Have you ever wondered how banks stay safe and sound in a world full of financial risks? The answer lies in a concept called microprudential regulation. This framework is all about ensuring that individual financial institutions, like banks, operate safely and manage risks effectively. The main goal is to protect customers, including depositors and investors, while preventing failures that could shake confidence in the financial system. Microprudential regulation sets specific standards that banks must follow. For instance, banks are required to maintain sufficient capital reserves. This means they need to have enough money set aside to absorb potential losses. Additionally, banks must hold enough liquid assets. Liquid assets are those that can quickly be converted into cash to meet short-term obligations. Another key aspect of microprudential regulation is strong risk management practices. Banks need to identify and control risks effectively. This helps to ensure that they do not take on too much risk that could lead to failure. Proper governance and internal controls are also essential. This means that banks must have clear structures in place to guide their operations and decision-making. Unlike macroprudential regulation, which looks at the financial system as a whole, microprudential regulation focuses on the health of each bank individually. This approach aims to reduce the likelihood of any one institution failing due to poor management or risky behavior. By doing so, it supports overall financial stability. Historically, microprudential regulation has evolved in response to financial crises. For example, the Great Depression led to the establishment of early banking regulations. More recently, the global financial crisis of 2008 highlighted the need for stronger microprudential rules. These rules are designed to prevent the failures of major banks that could threaten the entire economy. From a conservative viewpoint, microprudential regulation is viewed as essential for maintaining trust in the banking system. It aims to protect individual institutions and their customers through clear, enforceable standards. This approach avoids broad, systemic controls that might hinder economic growth or innovation. Conservatives generally support microprudential regulation as a means to promote responsible banking while limiting excessive government intervention. In practical terms, microprudential regulation helps ensure that banks remain resilient to economic shocks. This resilience allows them to continue providing credit and financial services, which are vital for economic growth and fiscal stability. It also reassures taxpayers and investors that their funds are protected, reducing the risk of costly bailouts. Ultimately, microprudential regulation is about safeguarding the financial health of individual banks through targeted rules and oversight. This not only supports a stable and trustworthy financial system, but also aligns with conservative principles of limited yet effective regulation, focused on protecting consumers and preserving market integrity.